So you're a business owner or an investor. You've poured your blood, sweat, and tears into building something valuable. But let me ask you a tough question. How secure is it, really? We're about to walk through one of the most powerful strategies out there for asset protection, the holding company. Think of this as the blueprint for your very own financial fortress. All right, here's our game plan. First, we're going to pull back the curtain on the hidden risks you might be facing right now. Then we'll introduce the holding company as your powerful shield. After that, we'll get into the nuts and bolts of how you actually build this fortress and, just as important, how those walls can come tumbling down. And finally, we'll help you figure out if this is the right move for you.
Okay, let's start with a little reality check. The truth is, way too many entrepreneurs are sitting on top of an exposed empire, and they have no idea about the dangers that are lurking right around the corner.
And look at this number, 50%. Let that sink in. Research shows that pretty much half of all business owners are going to face a major lawsuit or a big issue with a creditor at some point. This isn't some far-off what-if scenario. We're talking about a coin flip. It's something you have to plan for.
And if you're not prepared, the fallout can be absolutely devastating. See, without the right legal structure, there's no firewall between your business problems and your personal life. That means a lawsuit against your company could literally jump the fence and go after your family's home, your savings, everything you've worked for.
So how do you build that firewall? Well, this is where the holding company comes into play. And I want to be clear, this is way more than just extra paperwork. It's a purposefully designed shield, a much smarter way to set up your business so you can protect what really matters.
So what is a holding company exactly? Well, in the simplest terms, it's a parent company. Could be an LLC, could be a corporation. But here's the key thing. It doesn't actually do anything. It doesn't sell widgets or offer services. Its only job is to own stuff. Specifically, it owns other companies, which we call subsidiaries. It's like the manager of the managers.
And this is where the magic really happens. Strategic separation. You have the holding company, which owns all the high-value stuff. The real estate, the cash reserves, the intellectual property. It just sits there, safe and sound with very low liability. Then you have your operating company. It's out on the front lines, dealing with customers, employees, contracts, all the day-to-day action, which means it carries all the risk. That separation is everything.
You know, the best way to picture this is with that fortress metaphor. The holding company is your secure castle, and inside are all the kingdom's treasures. Your operating companies, they're the outposts on the frontier, fighting the daily battles. Now, if one of those outposts gets attacked with, say, a lawsuit, the castle itself and all that treasure inside is completely safe.
Okay, the theory sounds great, right? Powerful stuff. But how do you actually build this thing? Let's get practical and look at the actual blueprint for putting your fortress together. Building this thing follows a pretty clear path. First, you got to pick the right structure, usually an LLC or a corporation. Next up is a really strategic decision, which state you're going to file in. After that, it's the paperwork dance. File the formation documents, get a tax ID number, and open up a separate bank account. And then, the final, most important step, you legally transfer ownership of your assets and your other businesses into the new holding company.
And that step about choosing a state? Yeah, that's a bigger deal than most people realize. Different states have totally different perks. Wyoming, for example, is famous for its privacy protections and low fees. Delaware is kind of the gold standard for big companies because its legal system is so sophisticated. And then you've got Nevada, which offers strong privacy and, get this, no state income tax. Which one is right for you really depends on your goals.
Okay, now for a really important warning. A fortress is only as strong as your discipline in maintaining it. This is not a set it and forget it kind of deal. If you get lazy or sloppy, those protective walls can come crumbling right down.
The single biggest threat has a very specific legal name: piercing the corporate veil. Basically, this is when a judge looks at your whole setup and says, you know what, these don't look like separate companies. This just looks like your personal piggy bank. And if that happens, the court can just ignore the liability shield completely and let creditors come after the holding company's assets, or even worse, your personal wealth.
And as business attorney Aaron Hall puts it right here, the whole thing hinges on avoiding that intermingling. The second you start mixing funds, paying for your groceries with the business card, or covering a business expense from your personal account, you are basically handing your opponents a weapon. A court sees that and thinks, well, if you don't respect your own structure, why should we? And poof, your shield is gone.
So, how do you protect that shield? It really just comes down to good corporate hygiene.
You have to keep separate books and bank accounts for every single company. You never ever mix personal and business funds. Each of your operating companies needs enough cash to stand on its own 2 feet. You have to keep detailed records, and yes, that means boring stuff like meeting minutes. And anytime money moves between your companies, it has to be documented with a formal contract, like a loan or a lease.
All right, so we've seen how powerful this can be, but we've also seen the serious pitfalls. And that brings us to the most important question of all. Is building this kind of fortress actually the right move for you? Let's just lay out the trade-offs here. On the plus side, you get incredible liability protection. You get centralized control over all your businesses, and you can often get better deals on loans. But there are downsides. This thing adds a ton of complexity, and you have to be meticulous with your records. It costs more too, because you have fees for each company. And if you have other partners, well, managing all that can get complicated.
So let's be crystal clear about the final takeaway here. A holding company is an incredibly powerful tool. But, and this is a big but, it is absolutely not a do-it-yourself project. This is an advanced strategy. It needs professional architects, that means lawyers and accountants, to build it correctly, and it needs you to be disciplined to maintain it.
So there you have it. You've seen the blueprint for the financial fortress. You've seen how it's built, how it can shield your wealth, and the simple mistakes that can bring the whole thing crashing down. So the question I'll leave you with is this. Is the foundation you've built ready for a fortress this strong?